Certainly. Let's delve even deeper into each of the investment strategies and explore additional considerations for growing your retirement savings from $100,000 to $1 million. 1. Investing in an S&P 500 index fund. Diversification and stability. The S&P 500 index fund provides exposure to a diversified portfolio of 500 of the largest publicly traded companies in the U.S. This diversification helps spread out risk across multiple sectors and industries, reducing the impact of individual company performance on your overall investment. Long-term growth potential. Historical data shows that despite short-term fluctuations, the stock market tends to trend upwards over the long term. Investing in an S&P 500 index fund taps into this long-term growth potential, allowing your investment to benefit from the overall growth of the U.S. economy. Tax efficiency. Index funds typically have lower turnover ratios compared to actively managed funds, resulting in fewer taxable events. This can lead to greater tax efficiency, allowing you to keep more of your investment returns over time. 2. Focusing on growth stocks. Innovation and disruption. Growth stocks often come from companies at the forefront of innovation and disruption in their respective industries. Investing in these companies allows you to participate in the potential growth of new technologies, products, or services that could reshape entire industries. Risk management strategies. While growth stocks offer high potential returns, they also come with higher volatility and risk. Implement risk management strategies such as setting stop-loss orders or diversifying your portfolio across different growth sectors to mitigate potential losses. Research and due diligence. Conduct thorough research and due diligence before investing in individual growth stocks. Analyze factors such as revenue growth, profit margins, competitive advantages, and management quality to identify companies with strong growth prospects. 3. Considering dividend stocks. Steady income stream. Dividend-paying stocks provide a reliable income stream, making them particularly attractive for retirees or those seeking passive income. Reinvesting dividends can accelerate the growth of your investment over time through the power of compounding. Dividend aristocrats. Consider investing in dividend aristocrats, which are companies that have consistently increased their dividends for at least 25 consecutive years. These companies tend to be financially stable with strong cash flows, making them less susceptible to economic downturns. Dividend reinvestment plans, DRIPs. Take advantage of dividend reinvestment plans, DRIPs, offered by many companies and brokerage firms. DRIPs allow you to automatically reinvest your dividends into additional shares of the same stock, compounding your investment over time without incurring additional transaction fees. 4. Exploring small-cap value stocks. Potential for higher returns. Small-cap value stocks have historically outperformed large-cap stocks over long investment horizons. Investing in smaller companies with attractive valuations can provide opportunities for significant capital appreciation as these companies grow and become more widely recognized by investors. Patience and long-term perspective. Small-cap value investing requires patience and a long-term perspective, as these stocks can be more volatile and may take time to realize their full potential. Avoid reacting to short-term market fluctuations and focus on the underlying fundamentals of the companies in which you invest. Due diligence and research. Conduct thorough due diligence and research before investing in small-cap value stocks. Look for companies with strong balance sheets, sustainable competitive advantages, and attractive growth prospects trading at discounts to their intrinsic value. Strategic asset allocation and rebalancing. Asset allocation. Determine your asset allocation strategy based on your risk tolerance, investment goals, and time horizon. Allocate your portfolio across different asset classes, including stocks, bonds, and alternative investments, to diversify risk and maximize returns. Regular rebalancing. Regularly review and rebalance your portfolio to maintain your desired asset allocation. Rebalancing involves selling assets that have performed well and buying assets that are underperforming, ensuring that your portfolio remains aligned with your long-term investment objectives. Consulting with a financial advisor. Consider consulting with a financial advisor to develop a personalized investment plan tailored to your specific financial situation and goals. A financial advisor can provide valuable insights, expertise, and guidance to help you navigate the complexities of investing and achieve your retirement savings objectives. By incorporating these additional considerations and strategies into your investment approach, you can optimize your chances of successfully growing your retirement savings from $100,000 to $1 million. Remember to stay disciplined, stay informed, and remain focused on your long-term investment goals to achieve financial security and prosperity in retirement.